My name is Putukwane Madisha, and I'm the CEO of Housing Investment Partners, or HIP Housing as we call it. Housing Investment Partners is a company that was put together in around about, or conceptualized, around about 2007, 2008. The company was officially incorporated in 2009. Now, the main idea behind Housing Investment Partners is that, as we have seen in South Africa, there is a missing middle and there is a gap market. Housing Investment Partners aims to address the housing shortage that exists in the gap market. In South Africa, if you look at the financial spread of individuals in the country, as well as how housing is provided, you will see that there are three clear segments. The first is what we would maybe call the lower end or working class segment, which are individuals earning below 3,500 Rand gross income a month. These individuals qualify for social housing provided by the government. In 2006 or so, it started off as the Reconstruction and Development Program, RDP. It's later been rebranded as BNG, or Breaking New Ground. This is the government providing free housing to those individuals and households that can afford to provide their own shelter, basically. We then go into the top end of the market, which is where your banks are involved. Normal working individuals will apply for financing from a bank, get approval for a mortgage loan, and then seek to purchase a property through your various estate agents. We then have what we call the missing middle. Now, this gap is where we have individuals earning above 3,500 Rand gross income per month, so they do not qualify for social housing. But at the same time, they do not earn enough or earn the type of income expected by a bank for a bank to be able to offer them a home loan. And this is where HIP has tried to forge its place in the housing finance market in South Africa. The way HIP has tried to do this is by bringing together elements of government and the private sector to be able to produce a product and a service that can address the needs of the missing middle or the gap market. HIP was incorporated as a partnership between government spheres, being the Department of Human Settlements, through its state-owned entity, the National Housing Finance Corporation. They have come into HIP as a minority shareholder. We then have private sector coming in, and the Old Mutual Group has come in as a majority shareholder in Housing Investment Partners, providing the private sector funding required. HIP operates as a fund manager, but it then has created investment trusts that it uses to manage the finances of the investors, distribute the cash flows to potential home purchasers and to the developers of the properties, and then also collect the payments in terms of mortgage loan installments for the payment of those houses. The way HIP addresses the needs of the gap market is by targeting the affordability constraint that individuals that earn above 3,500 Rand but below 30,000 Rand a month face. Now, if you look at individuals earning above 3,500 Rand but below 30,000, you'll see that it's your run-of-the-mill sort of lower middle income earners in South Africa, a lot of them being government workers, and half of HIP's customers are actually working in the public sector. You're looking at individuals working sort of in policing, in nursing, and in teaching mainly. The way HIP has addressed the affordability constraint is by lowering the installments on a home loan in the beginning of the loan. These installments then grow gradually as your salary increases over the period of the loan, which is why we call it a salary-linked installment bond. How does this work? What you would do is, on a typical 500,000 Rand house, if you were to get a loan from a bank, they would quote you, depending on interest rates, but let's say it's around 6,000 Rand a month with some insurance included. And that quote on an installment would be the same installment you pay over a 20-year period, and it would amortize the value of your bond, which is now the debt behind your house, over a 20-year period. In the beginning of that loan, you'll be paying a lot more interest, but as time goes on, as you service your interest, you'll then start eating into that capital of the original 500,000. And over the 20-year period, eventually, you'll get to the 20th year, you'll pay off your house, and full ownership and title of that house will pass to you. In an increasing installment bond, it follows the same amortization principle, but the difference now being that in the beginning of the loan, you make smaller installments than what a bank would quote you. Let's say in HIP's case, on that same property where a bank would have quoted you around 6,000 Rand, HIP would quote you around 4,000 Rand. Now, in terms of the South African economy and the individuals in it and the households in it, imagine how big a difference a 2,000 Rand cash difference makes on a household, let's say earning 10,000 Rand gross a month. On a net basis, you'll be taking home, let's say, about 8,000 Rand. So an additional 2,000 Rand in your pocket makes a huge difference. And it could be the difference between whether you are able to obtain a home or not. So what HIP in essence does is it allows these households to purchase a home around 5 years earlier than they would have been if they were going with a traditional loan from a bank. Now, our studies have shown that in these 5 years, what a household is expected to do as the income of that household increases, they meant to almost save all those incremental increases, save them towards a deposit, but at the same time, build the financial discipline of not enjoying those increases in terms of consumption spending or maybe short-term loans and the likes. So you save up for a deposit. At the end of the 5 years, it might allow you to put down a 10 or 20% deposit on that home. And then that differential as well that you were saving, you can now put into your bond as your monthly installments. What we have found though in South Africa is that over that 5 year period, our people have not been very good, let's say, at saving those increases in income. So what happens is, as the salaries gradually increase over that 5 year period, they increase their consumption spending. They increase maybe some of the home short-term loans that they take out on furniture around the household. They'll buy maybe a fancier car than they need. Now, you can't really blame the households and the individuals. I mean, these aren't people earning too much money. They're earning around 15,000 Rand a month. So every extra Rand helps. But what we've found is that purchasing a home and having a home loan increases the overall financial discipline of a household. And therefore, even though your installment will be growing, you've already gotten used to making these monthly payments. So once you get to that 5 year mark where now you are paying the same amount as you would pay with a normal bank, you have disciplined yourself over that 5 year period of making your monthly installment payments. Yes, the increases will continue, so they don't stop at the 5 year mark. Your increases continue right up until year 20. But what we have experienced is that our best customers, from around year 3 to year 5, will now start seeing the benefits of the home ownership and the benefits of servicing their home loan, to the point where they'll be like, well, we don't want to see our installments increase indefinitely. And then it gives them an option to switch. And HIP will provide that option to switch from your increasing installment bond to a traditional vanilla bond with the same installment. There will be a slight increase in the installment you have to pay, but at this stage, your financial discipline has been built and that exercise is there in the household and in the mind. Now, I just want to cover maybe sort of 5 property topics, maybe some misconceptions or further knowledge around the property market that people may not know about. The first is that we must remember that we live in a global village. So South Africa's property market, which is integrally linked to South Africa's financial markets, do not operate in isolation. They are part of global markets. Now, why do I raise that? People might know that in Europe and the West in general, it is possible to get a home loan at around 1 to 2% fixed interest over a 20-year period. But that is because they have incredibly low interest rates. Now, as I mentioned, being part of a global market means that the financing you're going to receive in South Africa has to form part of international finance practices, if I can put it like that. Therefore, the same money that goes into a housing loan in South Africa basically comes from the same pool of money that would go into a housing or an equity investment in the States or in Europe. Therefore, you have to take into account the risks that any financial practitioner would employ on an international basis. And in South Africa, we are part of the emerging markets. So we are taking into emerging market risks. You have to take into account interest rate differentials, inflation especially. And these emerging market risks combined with inflation lead to this interest rate differential that you'll find between the West and emerging markets. And that is why in South Africa we experience pretty high interest rates of around prime and just above prime. If we go further north on the continent, you'll find that those rates get even worse and higher as those emerging market risks are more imminent. So, further in sub-Saharan Africa, you'll find countries that have, maybe prime interest rates around 20%, and that's where their home loans will be. And that is the first point I wanted to make. The second point is that once you look to purchase a home, as opposed to renting a home or building your own home, you now move between the spaces of a house being a provision of shelter to a house being a financial asset. And as I mentioned, as a financial asset, is part of the global financial markets. Now, why do I say time is critical? If you think of a financial asset, it is now an investment. So you have to look at your property purchase through the lens of an investor. There are two types of investing that happen in the world. The first is what you would call trading. Now, trading is trying to take advantage of short to medium term inefficiencies in the market. We are not going to cover that at all today. And I would suggest most people stay away from trading unless you really know what you're doing. I want to rather focus on what you would call value investing. This comes, from almost the thought process of the Warren Buffetts of the world and the likes. Value investing says you see an asset that you see has potential value over a much longer term period of time. You're looking over, 10, 20, 30, 40, 50 years of time. And that is the lens with which a home purchase should be seen through. So if you're looking to buy your own home, think of the time factors involved. Firstly, in South Africa, if you look at a traditional bond in South Africa, it generally takes about 10 to 13 years for a household to pay off its mortgage loan. So already you need to know that you're going to be indebted for about a 10 to 13 year period, and you're going to have monthly cash commitments over that period. So that's a very serious thought to put into mind when looking to purchase a home. You then obviously have to look at what is happening in the greater country environment, your area's environment, and specifically where your property is that you're going to purchase. You have to try and see where do you think that area or that property is going to look like in 10 to 20 years' time. I've covered the third one, which is mentioning the shift from housing being a form of shelter to investing. And that is very critical when you're looking to buy a house, especially if you're taking out a mortgage loan. Now, when you purchase a house, it's not a like-for-like comparison between do I purchase my home or do I rent my home? And especially in the lower ends of the market, we're talking about your working middle class. At this end of the market, there are very large positive benefits from purchasing a home, not purely financial and not purely shelter. We have seen that people that purchase their own home, especially through taking out a mortgage bond, and I'd mentioned it earlier about exercising this financial muscle in your brain almost, is that when people purchase their own homes and take out a mortgage bond, they make much better overall financial decisions in their house. Why is this? I touched on the first reason, is that already you're taking on a much longer term view of your home and of your financial future as a household. So already if I know that it's going to take me about 13 years to pay off a house, at the very least today, I'm going to make sure I maintain this house. I keep it in a very good condition because I want this asset to remain valuable. I'm going to make sure that myself and my neighbors are paying their rates and taxes so that the location we are in can also be better serviced by the government, and we make sure that our roads are in good condition because this will also affect the value of my house. Now also internally inside the household, we found that even school children perform better at school when a house is being bought versus being rented. And this just goes into the mindset of, hold on, this is a very serious commitment I'm making. This is certainly the biggest assets I'll ever purchase. I've got to make sure that my household runs efficiently to be able to pay off this house so that we'd one day own it. And more importantly, so that the value of this house remains in place so that even when I'm gone, I can pass it on to my children and future generations. And therefore, overall, households make much better decisions. Now, instead of sort of saying, are we going to go on a fancier holiday or are we going to buy that fancier car, you'll find households making much more grounded and financially valid decisions around maybe we should take this extra money, put it into the household, pay off our bonds earlier, and increase the wealth in our household. Now, lastly, a house is usually the easiest way for an individual to enter the investment world. This is mainly because of the concept of leverage. And leverage just means that you can borrow money to pay for something. If you go to the stock market and look to buy shares, there's no leverage involved there. You need to have, if I want to buy 100 rands of shares, you need to have 100 rand. Now, to buy a 100 rand house, luckily, you don't need to have 100 rand today. Depending on the deposit required by a bank, but in nowadays markets, you're looking at about 10%. So you would need to have 10 rand today, and then over time, pay off that particular asset. Now, leverage unfortunately works for the good and the bad, so I do want to touch on that. On the good side, if the return on that asset you are purchasing, and now in this case would be a house, if the return on that asset is higher than the cost of your debt, leverage works for you. Now, how does that work? I'm buying a 100 rand house. I borrow the 100 rand to buy the 100 rand house. In a year's time, I must now pay off the house. If in a year's time, my debt is now 110 rand, I will need to find that money from somewhere. So idea is you, let's say, sell the house in a year's time to pay off the debt. Now it's all about what's the value of the house in a year's time. If it's worth 110 rand, I've come out even. If it's worth 120 rand, I've made 10 rand. If it's worth 90 rand, I would have then lost 10 rand. So the whole, I would have lost 20 rand if it's 90 rand. So the whole idea is that you can borrow money to purchase a house. Now, in terms of buying a house, leverage is almost always good for you. And the main reason is that you got to look at the alternative. If you weren't going to buy a house, you'd be renting. Now, in every example of renting, you do not get the money back. So all that money that you would have spent on renting, you will now receive back as value in your property. It allows you to now enter the investment market with very little relevant amounts of capital. You don't need millions and millions of rands to buy a $1 million rand house. And on top of that, over time, as you build wealth within that initial property, you can actually use that wealth to now, let's say there's a shock in the family and you need to expend on medical expenses or school fees or anything. You can actually take that value out of that house to pay off these other emergencies that might be happening in your life. And eventually, you could also take that value from that house and use it to now purchase second and third properties. And which is why property is almost always the best way to enter the investment market, because it allows you the greatest degree of leverage versus any other investment. And those are my 5 points.